It begins with a financial shock so severe and so violently out of sync with everything investors believe they understand, that even hardened US market veterans pause and reread the numbers as if their screens are malfunctioning. An ETF trades for roughly $6, yet it has distributed more than $20 over the past year, a payout several times larger than the ETF's own market value, a yield so extreme that it breaks every intuitive link investors rely on to judge risk, sustainability, and value. It feels like the market is glitching, but there is no glitch. The filings are correct, and the distributions are real, traded daily on NYSE Arca with full regulatory approval. That contradiction is what makes MSTY feel like a crack in the logic of modern finance. This instrument, the YieldMax MSTR Option Income Strategy ETF called MSTY, launched on February 22, 2024 in the United States. From day one, it behaved unlike any conventional ETF tied to a single US stock. Under normal ETF mechanics, the fund owns shares of the underlying company. When the company rises, the ETF rises. When it falls, the ETF falls. Upside and downside move in a straightforward chain. But MSTY does not own MicroStrategy at all. It constructs synthetic exposure, basically an engineered imitation of ownership, like using cash, short-term US Treasuries, equity-linked notes, total return swaps, and flex options. These instruments replicate MicroStrategy's price movements without giving MSTY the same structural symmetry as actual share ownership. Once that synthetic exposure is created, MSTY sells call options or narrower call spreads to collect weekly option premiums. In a typical covered call ETF, selling calls generates moderate stable premiums and sacrifices some upside. Those funds do not produce multi-100% yields. They do not distribute several times their share price in a single year. And they certainly do not suffer catastrophic capital erosion while paying extreme distributions. MSTY's behavior, measured against normal expectations, sits far outside the bounds of traditional income investing. Everything changed in 2025. Bitcoin entered a violent unwind. MicroStrategy, because of its enormous Bitcoin holdings, that behaved like a leveraged crypto instrument. Its stock fell from roughly $540 to around $170. Under normal circumstances, an ETF tied to that stock might fall 50 or 60%. But MSTY collapsed more than 80%, falling into the $6 region by early December. Here is where the mystery intensifies. Instead of shrinking its distributions the way any normal income ETF would when the underlying deteriorates, MSTY increased them. The more MicroStrategy collapsed, the more MSTY paid out. This behavior flips the entire logic of income investing. In normal structures, falling asset values weaken cash flows and